So let me give you some idea of the topics that we'll cover this quarter. And this is the order that we'll cover them on. The beginning of the class starts out a little bit slow in that we have to describe what futures markets are. I know some of you have no idea what these institutions are. So I start out with some fairly general discussion, a bit of history, and some discussion of their economic role to give you a flavor of the importance of the institutions, their growing importance. This industry is changing very, very rapidly. And then we go on to some of the what I call the market mechanics, which is really the nuts and bolts of how these markets work. The contracts are standardized from commodity to commodity or financial asset to financial asset. The industry is highly regulated by the government, so we'll discuss that. And we'll discuss the basic mechanics of how trades are executed, how you actually enter into a trade, how the financial integrity of that trade is guaranteed, and so on. So therefore, starting in on StockTrack on Friday is very helpful because we're describing the very basics the first few weeks, and if you start trading on Friday, that will help you understand the material I'm covering. There are two main categories of contracts that are traded. There are subcategories as well that I'll refer to this morning. But basically, you have a set of commodities, what we call commodities. The largest volume commodity futures market happens to be crude oil in New York. So there are a lot of commodities that are traded, such as crude oil, wheat, cotton, live hogs, and so on. And then there's a large set of financial instruments that are traded. And for the most part, these include interest rate futures. The largest volume financial contract in the U.S. happens to be Eurodollars, which is a short-term interest rate on U.S. dollars deposited in European banks. You have U.S. Treasury bonds, and you have a large number of equity futures, for example, the S&P 500 index and so on. So we have our commodities, and we'll discuss price behavior in the commodity side. We'll discuss price behavior on the financial side, and that will take us about halfway through the course. So by then, we'll have a pretty good understanding of how these markets work and what are the major differences between the financial instruments and the commodity side. I put a lot of emphasis on the financial futures. We'll discuss exchange rate futures and interest rate futures in considerable depth. The next topic is fundamental and technical analysis. There are basically two schools of thought with regard to forecasting prices. When you're trading StockTrack, you're trading as a speculator. Your objective is to make as much money as you can in the next 10 weeks as a speculator. In the real world, there are two groups of traders. There are hedgers who are involved in the commercial side of the business, and they're using the futures market to reduce price risk. The example I gave you on Friday was out of an airline purchasing jet fuel, and the price of that fuel fluctuates wildly, and they try and reduce the risk of fuel price fluctuations by hedging on the futures market. Financial firms are also large hedgers. Firms that buy and sell mortgages, the price of the mortgage for a house will vary quite dramatically as interest rates vary, and they hedge their purchase and sale by participating in the futures market. So you have those two types of traders, and the speculators, and that includes you for this quarter, follow two different approaches. A fundamental approach looks at supply and demand. It tries to determine the intrinsic value of an asset. What what should the price of gold be today based on supply and demand characteristics? That's what a fundamentalist will look for. They will study the market. They will study the trend with regard to inventories, with regard to production, with regard to demand. And based on that information, try to forecast where the price of gold is going. Technicians, on the other hand, pretty much ignore supply and demand and focus on past price behavior. They look at charts, price behavior on charts, and they try to forecast the future based on the past. So they believe that patterns associated with price behavior follow recurring events, and they try to identify recurring price patterns and forecast accordingly. So once we get through that material, by then we're ready to tackle hedging. As I said, hedging provides a major economic rationale for the operation of futures and options markets. So we'll spend a week or so on hedging with futures, and I will really leave options until the end of the class. In the introduction, I'll briefly touch on options, but 80% of the class will focus on the futures market, and the options that we discuss and analyze towards the end of the class are written on the futures contracts. So we have to have a thorough understanding of how futures markets operate, how traders in the futures market behave, before we can jump into options on futures. So options on futures comes at the end, and we'll go through some of the mechanics, understand price behavior in the options market, and then we'll look at hedging with options, which is an alternative to hedging with futures. And the final week in the class, we'll compare hedging strategies with futures contracts versus options. For example, if you're running the hedging program for Southwest Airlines, they buy a lot of fuel, you can either use the futures market or the options market. Okay? I'm going to have to ask you folks to please come to class on time. We're taping these lectures, and it's very distracting to have people walking in 10 minutes late. Okay? Thank you. So if you're running this hedging program for Southwest, you have to decide whether you're going to use futures markets or options markets, or a combination of the two. And we'll look at the benefits versus the costs of using one strategy versus the other. And that will conclude the class. Okay? So this set of quotes, which you'll find in the book, just serves to illustrate how colorful the industry is. The first chap, Ken Roberts, used to be an Amway salesman, and then he started selling trading techniques. And there are plenty of folks in the industry like Ken who try and attract naive speculators by promising large rates of return. You buy my trading system, and you'll probably earn 300% on your money over the next 6 months, this sort of thing. So we'll have a look at the sorts of trading techniques that Ken sells and others when we discuss technical analysis. He's a technician, okay? And according to Ken Roberts, anybody can make a fortune trading futures and options markets. And then we have a quote from another gentleman who has written several books on the regulatory side of futures and options markets, and he never trades. The reason he doesn't trade is he believes that the markets are too efficient. It's very difficult for him to make money trading futures or options, given that the markets are really a global marketplace. Information freely flows into the gold pit in New York or the oil pit in New York, where they actually physically trade these contracts. And he doesn't trade because he thinks it's impossible for him to outwit all of the other participants in the market. So there's just an example of two different attitudes when it comes to this industry. So we'll spend a little time just describing the economic rationale for these markets. As I said on Friday, the futures market has been around for about 150 years in the form that we know it today. And one of the reasons that it has grown very rapidly in the last 20 years is that many new contracts have been introduced that are non-agricultural. 150 years ago, it was only agriculture. Up until the 1970s, there were very few non-agricultural contracts. In the 1970s, the markets introduced financial futures, basically interest rate futures, and options were introduced in the early 1980s. And I'll show you later, there's been a tremendous growth in the volume of trade. The primary function of these markets is what we call the discovery of prices. So it's a marketplace. That's where supply meets demand. And the price plays a very important role in that it allocates supply to given demand. In other words, it rations available supplies. There's a certain amount of confusion among the general public when it comes to understanding this industry. In fact, there's some friction between the securities industry in New York, the New York Stock Exchange, and the futures industry, which is largely based in Chicago. There has been this long-running rivalry between Chicago and New York, and the view in New York is one of, I'm generalizing of course, is one of a bit of snobbery, and that those exchanges in Chicago are nothing more than gambling dens. It's just like going to Las Vegas if you're buying or selling futures contracts. Whereas in New York, we buy and sell equities, they're shares in actual companies, and so there's something that's underlying what we're buying and selling. Whereas in Chicago, you know, you can buy a futures contract on the Standard & Poor's 500 index, which doesn't even exist, right? So how can you possibly argue that this is serving some useful economic function? Well, clearly the folks in New York are wrong, and for the following reason. The contracts that have been successfully introduced for futures trading are all somehow tied to our economy. Whether it's exchange rates play a critical role. If you're exporting or importing products or services, you must convert foreign receivables to domestic currency and so on. So whether it's exchange rates, whether it's interest rates, loosely defined, interest rates are the price of money. And most businesses today are highly influenced by the price of money, by interest rates. Your typical business has an operating loan, and so fluctuating interest rates affect the bottom line. And so there's uncertainty in that market. There's uncertainty in the exchange rate market. That's inherent. It's part of supply and demand. There's uncertainty in the crude oil market, another large commodity. Why does the price of crude oil fluctuate from day to day, from hour to hour? Well, it's supply and demand. It's rationing available supplies. If there's a shortage of crude oil because of a storm in Venezuela that's knocked out some oil production, or a storm in the Gulf that's knocked out an oil refinery, if there's a supply shock, then the price must rise to discourage demand and encourage more production. That's what economics is all about. One reason our current governor, Mr. Davis, is in trouble is when the energy market in California was deregulated, he decided not to allow the retail price of energy to rise. In other words, the homeowners did not see higher energy prices, higher electricity prices basically, a couple of years ago when the market spiked up dramatically. It was only at the wholesale end. He held retail prices constant. Well, how do you suppose the typical homeowner responded? Do you suppose they cut back on using electricity? No, why would you? The price hasn't changed. So that's one reason why California ended up with this large deficit in electricity, was that the retail price remained the same, consumption remained the same, and the wholesale price was rising rapidly. Now, if the governor had allowed the markets to work where the retail price also rose, people would have gone around and shut the lights off once in a while. So in the crude oil market, you can't fix the price of crude oil. It has to fluctuate based on supply and demand, and that's true for all the markets that we'll discuss during this quarter. So as a result, if you're involved in some commercial enterprise, suppose you're an exporter and importer, so you're exposed to currency risk, or you're providing transportation services like Southwest, you're exposed to the price risk of fuel, basically oil. The markets provide a mechanism for you to manage this risk. You can't go out and buy insurance against a fall in the price of crude oil for the simple reason that the insurance companies could not afford to write such a policy, or if they did, the premiums would be so high they wouldn't sell any policies. I mean, if you think about insurance for earthquake risk in San Francisco, I think it becomes obvious. Why do you suppose that premiums for earthquake insurance in San Francisco are so high? That's one reason. In addition, okay, just to me or to everybody or to everybody. So there's a high chance that they have to pay out. Typically, you have to have insurance in order to get a mortgage. It has a lot to do with the fact that if an earthquake hits, it's an event that impacts everyone at the same time, unlike a fire or a car accident. I mean, we all insure our automobile or our properties for fire, or the automobile for collision insurance. And the probability that I will have an accident this quarter in my automobile is pretty much independent of that from anybody in the room, okay? Unless, of course, you see me driving around after the midterm. But apart from that, these events are somewhat independent. So the insurance company can diversify the risk, sell us all policies, and the premiums are not too unreasonable, because one or two of us might have an unfortunate accident, but that's independent of everyone else in the room. Whereas with the earthquake insurance, as you said, if I get hit, everybody gets hit, so the company goes broke. Therefore, they don't sell insurance that will lock in the price of jet fuel or lock in interest rates or the price of corn or anything like that, because these prices are inherently unstable. It's economics. And if they did sell such a policy, let's say to the airlines, then everyone would cash in at the same time and it would break the insurance company. So there's really no other mechanism out there for firms to buy insurance, if you like. So if you're a hedger, in a way you're buying some insurance. It's not perfect, but we'll understand that as the quarter proceeds. You are really buying a type of price insurance. The speculator is selling the insurance. So that's why both Groups of participants are important. Even though I can make fun of Ken Roberts, he's an important player in the market because he risks his money and that of his clients in the marketplace. As a hedger, if I want to buy a crude oil contract, as a hedger, if I want to sell a euro-dollar contract or buy a treasury bond contract, people like Ken Roberts are willing to take the other side of the market. In the futures market, for every buyer, there has to be a seller. So if a hedger wants to sell or a hedger wants to buy, and they'll take both positions, then you need someone to take the other side of the market. It's possible it's another hedger, but quite often it's a speculator. So there have been many contracts that have been introduced over the years in the futures industry that have not succeeded because we have failed to attract a nice balance of hedgers and speculators. Those markets that you see today, and we'll discuss this quarter, for the most part are successful for the simple reason that there's a sufficient number of hedgers and speculators who trade on these markets. So we have liquid volume. If you put in an order, chances are it'll be filled very quickly at a price that you're happy with. If you want to reverse your position, you can do that very easily. Yes, sir. Yep. So the question is, insurance companies make money because there's a premium? Absolutely. How do speculators make money? Well, the answer to that question is that over time, the hedgers, if we view it in this context, pay a very, very small premium to speculators. Speculators are not taking large amounts of money out of these markets. It's a very competitive market. Speculators are attracted by the high potential return. Some speculators might have a nice diversified portfolio. If you're holding a bunch of stocks, you might also invest in the futures market. But the truth of the matter is 80% of the speculators lose money trading. Many of those are small traders. They'll lose $10,000 or $20,000 and you won't hear from them for another decade. Then they'll come back and start trading again. There's a small group of large professional speculators who consistently make money. But on average, the speculators are not making large amounts of money from year to year. So they're willing to invest in anticipation of making a profit. Some of them do. Many of them don't. You satisfied with that? Well, as a speculator, you don't necessarily care about the underlying reasons why this price is fluctuating, right? You don't really care why the price of oil is fluctuating. You might want to learn and understand it, but fundamentally, if you weren't in the market, it wouldn't affect you that much, right? If you weren't in the market, it's not as though you would lose your house or your business or whatever. So as a speculator, you're simply trying to profit from these price movements, and so you're willing to take your money, go in the market, and buy and sell accordingly. And that's great for the industry because it provides liquidity for the hedgers, and a market would never succeed on just hedgers alone. You need both the speculators and the hedgers. And of course, there are many speculators out there who feel that they can forecast the price, and some are successful, but it's not easy. Okay? So that's a little background on discovery of prices. Please ask questions if you have no idea what I'm talking about. Now's the time to bring this up over the first 2 weeks. The first 2 weeks, we really have to get comfortable with what this industry is all about. So it's largely about discovering prices, providing a mechanism for hedgers to offset price risks. Futures markets establish prices for deferred delivery. and that's why they're called futures markets, that they establish prices for distant months. Let me give you an example. So I'm going to the Wall Street Journal page here. On Friday, I suggested that you consider signing up for the Wall Street Journal. Not only you get the print edition for this quarter, but also the electronic edition. And you can find that link on the website. The nice thing about the electronic edition, they have very good price information. So I'm going to the Commodities section here. Let's see. My computer is making all kinds of strange noises. Okay, there's a story about the coffee market. I want to find an example here for you. Okay, let me go to energy futures. So here's a set of price quotes for the oil market. So I talk about crude oil. The largest crude oil market is on the New York Exchange, the NYMEX, New York Mercantile Exchange. And I have a link for that exchange on the website too, as I do for most major exchanges. So you can go to that exchange and you can find out a lot of information about oil if you're interested. But this way of reporting prices, and we'll talk about it in greater detail later in the week, is very standard. You have the contract, so it's light crude oil. You have the month, and then you have some price changes. So the month is what's referred to as the delivery month. So crude oil is a commodity, and it's a commodity that's deliverable. In other words, if you buy a crude oil contract and you wait until the delivery month and you, quote, stand for delivery, you will receive 1,000 barrels of crude oil. Each barrel is about 42 gallons, so 42,000 gallons of crude oil. So if you purchased one of these futures contracts and held on to it until the delivery month, you would in fact receive a phone call from the exchange saying your crude oil is out in front of your house. Not really. They'd say, you've been delivered 1,000 barrels and your crude oil is sitting in a pipeline in Oklahoma. So you now are a proud owner of 1,000 barrels of crude oil. But let's just look at this for a second. Looking down here, and I don't know if you can read this or not. The print is a little bit small. Let's see. Also, I want to hide this here if I can. Yeah. Okay, there's a list of months here. The first one is November 03, so that's pretty close. Then we have December 03, January 04, and so on. 04, we go into the 05s, and all the way down to DEES 09. Okay, so that's pretty amazing. This contract, you can actually buy or sell crude oil for 6 years into the future. So that's why it's called a deferred delivery market, because you can actually buy or sell up to 6 years in advance, which is not always typical. For some markets, it's only 1 year or perhaps 18 months. There's not much trading on the very distant months, but at least there's an opportunity there for you to buy or sell one of those distant contracts. And you can see that there are a large number of alternative contracts. So let's just pull up a nearby contract here. Let's see. Well, I'll do it this way. This is a graphical representation of daily price activity. And this is why I'd like you to pay attention to the Wall Street Journal, because you have to be familiar with these types of graphs. So this shows you the recent price activity since July of this year. Okay, and we can go back further in a second as well. And since July of this year, the price has ranged between $27 a barrel and $32 a barrel. So these would be, I think these are daily prices. And this is what's called a bar chart, where the vertical line gives you the range in a given day. So the market traded between $27 and $27.50 on a given day. And the little horizontal tick indicates where the market opened and closed for that given day. So you just look at this and you get a visual idea of price fluctuations in this market. As I said, the crude oil market experiences volatile prices. Back in July, the price was around $28 a barrel. It then rose and reached a high of about $32 a barrel. Sometime in August, dipped down, rose again, latter part of August, $32 a barrel. It then dropped to 27 and is now back up to $28.50. So that's just one example of one contract in one market. So this is a futures contract. If you had purchased this is for November delivery. If you had purchased a futures contract for November delivery back in July, then you agreed to take delivery of 1,000 barrels of crude oil in the month of November, and you promised to pay $28. That was the price in July. Then as the market rose and it got up to 32, well, at that point you could have sold your contract. It's very easy to do. If you buy today, you can sell tomorrow. If you bought at 9 o'clock this morning, you can sell at noon, or vice versa. Maybe you bought a contract at 28 and I sold one at 28. Then as the price rose, on any given day, you could reverse your position. So once it got up to 32, you might look at your account and you say, well, this isn't too bad, right? I've made $4 a barrel, 1,000 barrels per contract, that's $4,000. So you would liquidate your position by putting in an order to sell a November crude oil contract sometime in August. So you bought at 28, you sold at 32. That's how a speculator makes money, right? You buy low, you sell high. And then you may have turned around the next day and sold a November contract. By doing so, you agreed to deliver 1,000 barrels in the month of November. So it's just the opposite commitment. You agreed to deliver 1,000 barrels in the month of November. And in return, you would accept $32, assuming you sold at the $32. And now the price has dropped down, right? It went down as low as 27. And if you were really smart, or maybe you bought Ken Roberts' book, right? Went down to 27. Well, that's another $5. You sold at 32. You could turn around and you could buy at 27. And you get back out of the market. So since July, you went long, or you bought November oil, then you sold it, you liquidated it. Then you turned around and you went short, or you sold November oil, and then you liquidated it again. And over the course of that trading period, you made $4 on the first trade and $5 on the second trade. So as a speculator, you know, with 20/20 hindsight, this is how you can make money trading futures contracts. You buy at a low price, you sell at a high price. Every contract has specifications that reflect the delivery month. So here we're talking the month of November. A delivery location. In the case of crude oil, delivery is to take place in Oklahoma in a pipeline. There are some alternative delivery points, and the price at the alternative points would be at a premium or discount to that Oklahoma price, depending on how the market works. And all the other terms and conditions are established by the exchange, except for the price. The price is established on the floor of the exchange, the buyer and the seller. In the U.S. markets, during the day, daylight hours, we still have what's called floor trading, and I'll show you a video next week where it's a physical, the NYMEX is a physical location. Individuals are on the trading floor. They're receiving orders over the telephone, and they go onto the floor and they offer to sell or they try to buy, and a contract is executed once a buyer and a seller agree on a price. So when you purchased the November crude oil, initially back in July at $28 a barrel, you sent your order to the floor. Somebody would have to be willing to sell at 28. If someone is willing to sell at 28, you buy at 28, then a trade is executed. Similarly, when the price rose to 32 and you decided to sell, then you put your order in to sell on that day. Well, someone has to be willing to buy at 32. Otherwise, your trade is not executed. So if someone's willing to buy at 32, then your trade's executed. You bought at 28, you sold at 32, so you're out of the market. Yes?
Doesn't this mirror the stock market? In the stock market, you don't get an actual commodity, you're getting part of the company.
So the question is, doesn't this mirror the stock market? Well, this is a market, right, like any other market. And in this case, we're trading futures contracts, which is really nothing more than an obligation. It's a legal obligation. It's a commitment. So when you buy the November crude oil, you're not actually buying the oil. You're promising to buy the oil. So you're only entering into an agreement to buy the oil. It's legally binding. And you can reverse that position by entering into an opposite agreement. So most trades never result in delivery. Less than 5% of the oil contracts ever result in delivery. Most hedgers really don't want the oil in Oklahoma. They might want it in Long Beach or some other location. So they're not interested in taking delivery. Clearly, the speculators aren't interested in taking delivery. So quite often, the positions are liquidated and there is no delivery. There's also a large number of contracts where delivery is impossible. You can't deliver the S&P 500 index because it doesn't exist, right? It's a theoretical construct. So there, in the delivery month, all outstanding positions are simply settled at the cash price on that day, whatever the S&P has to be based on the underlying stock market. So in answer to your question, it's a market, just like lots of other markets, but it's somewhat unique in that what you're trading are obligations to buy or sell at some future date. Therefore, when you enter into the obligation, you only deposit a small share of the total value of the asset. Okay, so we're talking 1,000 barrels of oil at $28 a barrel. The total value of that contract is $28,000, correct? 1,000 barrels times the price gives you $28,000. So when you buy a November contract back in July, you don't have to put up $28,000. That's the nice thing about futures trading and one aspect that's very attractive to speculators. You only put up a small fraction of that amount. It's called a margin deposit. And it depends on the commodity. But in the case of oil, it's probably something like $2,000. So if you deposit $2,000 with your broker, then you can enter into such a position for the simple reason that you're only promising to buy the oil in November. You're not actually buying it yet. So this gives you a tremendous amount of leverage in the market. If you're buying the contract for $2,000 and it's worth $28,000, that gives you a lot of leverage. And it's another reason why you could quickly lose your $2,000 or quickly double your money. Okay? Yes, sir. Mm-hmm. Okay, so the question is, if November rolls around, and so we bought at this point? Yeah, okay. So you bought and you want to turn around and sell, and nobody wants to buy from you. Well, what happens? Well, if you're trying to sell and nobody wants to buy and everybody else is trying to sell, chances are the price will fall, right? And hopefully the price will fall to such a point where somebody comes out of the woodwork and they're willing to buy. So the likelihood of that happening is extremely remote, especially in a market like this where there's literally hundreds of thousands of open positions for the most part. So the market is pretty effective in finding a point where you will find someone who's willing to take the other side of the market. Okay, so you want to sell, so you need to go in and put an order in. You say, I want to sell at 32, and if everyone just folds their hands or goes for a cup of coffee, well, okay, you're trying to sell, so you have to offer a higher price. Okay, so the market will equilibrate and clear, hopefully, but if that's not the case, to complete the answer, if you bought and you don't sell before delivery date, then you receive 1,000 barrels of oil. Okay, because given that you have bought, there has to be somebody on the other side of the market. For every buyer, there has to be a seller. So there's at least one other trader that had previously sold and had not reversed their position. So they're obligated to deliver the oil. So if you do buy and you don't reverse your position, then in the case of oil, you'd actually receive the oil. Okay? Then you'd have to pay the full. That's right. Yeah. You'd get a phone call and say your oil's in Oklahoma. Send us a check for the full amount. I mean, you would have put down a margin deposit and perhaps some margin calls, and then you get a call for the full amount. Okay? Yes? So the question is, how likely is it that you will receive 1,000 barrels of oil? The answer is highly unlikely. If you don't want the oil, then you just reverse your trade and sell the same contract. You sell a November contract. These contracts are standardized, so every November contract's the same delivery point, same delivery month, same type of oil, same number of units, and so on. So you sell a November contract, and then you liquidate, and you're not obligated to actually take delivery. But, you know, as he was asking, for some reason, you know, maybe you forget or you want the oil, yeah, it's possible to take delivery. So it's certainly possible to stand for delivery if it's a deliverable commodity, but it happens very rarely. Like I say, maybe 5% of the, somebody's anxious, 5% of the contracts result in delivery. Now, let me just mention as we get into StockTrack, so you will notice that you can, let's say, buy an oil contract for whatever the margin requirement is in StockTrack, and I don't remember. It'll be $2,000 or $3,000, and which is fine, but please don't spend. You'll start with $200,000. So don't go out and spend all of your $200,000 on highly leveraged positions, because you can initiate a position for $2,000 in the case of oil. If the market moves in your favor, in other words, if you buy and the price goes up, well, that's great. In fact, your account is credited with the profit every single day. But if the market moves against you, then you have to put up additional money, and that's what's called a margin call. Because at the end of every day, the clearinghouse, which is part of the exchange, brings every contract to the current market price. So if you bought oil at $28 a barrel, and then the price fell to $26 a barrel, well, on paper at least, you would have lost $2,000. It's $2 a barrel times 1,000 barrels. So you started by depositing $2,000, and all of a sudden you've lost $2,000. I just lost my projector, that's okay. So you get a phone call that says, we need another $2,000. The next day, the price drops another $2. It goes from 26 to 24. You get another phone call. We need another $2,000. So as the market moves against you, you do have to put up 100% of your paper losses. That's what's called margin call. Okay, I'll see you Wednesday.